Hi, this is Rob Beardsley with Lone Star Capital, and I wanted to talk about some of the market dynamics that we're observing today. We're recording this right now, May 2021. And so we just finished doing a research. We read every single CoStar submarket report for Houston, our main market focus. And the theme that we noticed was that there was kind of basically two different types of markets. There were the markets that were the historically growing, where the new jobs are, the path of progress, and they're exciting, and there's a lot of development, and it's kind of the more hip places to be, more sexy, more institutional, and those markets saw negative rent growth since COVID and are experiencing kind of the hangover of a lot of new supply that hit pre-COVID and that's still being built post-COVID. There's just a big supply coming into those markets because developers want to be developing in the places where there's population growth, job growth, where it's an exciting place that people want to live. And all that development quickly overwhelms any of the beneficial demographic movements or improvements or growth that's occurring organically in the submarket. And that's why you're seeing the negative rent growth, concessions, increases in vacancy in those submarkets. Then on the other hand, you've got the submarkets that are kind of the workforce housing submarkets, maybe less exciting demographically and maybe less investable from an institutional perspective, right? Maybe more institutional investors are typically really favoring the higher end, the CBD, the downtown. And so these workforce housing submarkets are certainly not that. But what we saw is positive rent growth in 90% of those submarkets. So, and I think that's not just a COVID-related flight to affordability or a flight to the suburbs. It is that there has been benefits there to those certain submarkets where actually people are leaving from the, walkable work, live, play living scenarios, and they're going to the suburbs. But even more important, dichotomous performance of these submarkets just continues to prove out the workforce housing thesis, the durability of those markets, and the resiliency of those markets through ups and downs. Just because those tenants are renters by necessity and they don't really have other options. They're renting in a certain area probably because of their job, and they are most concerned about affordability. So they're looking for the affordable workforce housing option. And so those are sticky tenants, and that segment is supply constrained, right? All the developers are building in the sexy submarkets where there's booming jobs and all the new restaurants, and they're building very expensive, mid-rise and high-rise that are commanding, anywhere from $150 a foot to $250 a foot. And meanwhile, workforce housing rents are anywhere from 90 cents to $1.20 a foot, and a developer simply can't build to those rents and get a return. So it's not economic for them. That's the other reason for the resiliency of those submarkets, is just they're simply supply constrained and have continued to grow. And we're seeing some of our more favorite submarkets are really the submarkets that have the blend of both. And so it's how close can you get to the sun without getting burnt, right? Because if you're a submarket that's decidedly a growth submarket that's been identified by developers, there's going to be new supply, and it's going to really mute the benefits associated of that growth. So if we're always looking to find those submarkets that have those strong workforce characteristics that's going to make it a resilient investment, but then also have strong population growth and the prospect for continued rent growth, which obviously we need to avoid the new supply risk in order for that to happen. So we're conscious of the area not becoming institutionalized or really attractive for developers. So hopefully that made sense, and thanks for watching.